Right now, as you're watching this, Brent crude is sitting at $101 a barrel. Gold just hit $4,370 an ounce. The UK just had nearly 1,000 mortgage products pulled from the market in a matter of weeks, and the Eurozone is pricing in a recession. But here in the US, the S&P is holding. Jobs are still being added. The Fed is holding rates steady. And the government just announced a $100 billion stimulus package they're literally calling bundles of joy. So what the hell is going on? Is this the beginning of a global crash? And if it is, why is America looking different? That's exactly what we're breaking down today. Stay with me. The answer is going to surprise you. To understand why markets are doing what they're doing, you need to go back to February 28th, because that's the day everything changed. The US and Israel carried out a series of strikes in the Middle East. And the outcome, I don't want to get too deep into the politics here, but the outcome was an escalation that nobody on Wall Street had fully priced in. The Iranian response? They focused on the Strait of Hormuz. Here's why that matters for your money. That strait, that stretch of water, is where 20% of the world's oil and liquefied natural gas passes through every single day. Think of it as the planet's most important financial artery. And when it effectively closed down, the numbers moved in ways we haven't seen since the 1970s. Oil went from $70 a barrel to $119.50 in a matter of weeks. The IEA, the International Energy Agency, called this the most severe energy shock since the 1970s.
And I want you to think about what that actually means in practice.
This isn't just about gas prices at the pump, although that's part of it. When oil spikes, everything moves. Shipping costs go up, farming inputs go up, aviation goes up. The price of getting anything from anywhere to anywhere goes up. And that feeds into inflation in a way that central banks absolutely hate. Now here's the thing. There was a brief moment of relief. On March 23rd, Trump announced a 5-day pause on further strikes on Iranian energy infrastructure. Crude dropped 10% almost immediately. Markets bounced. But, and this is the key question, is that actually the beginning of de-escalation? Or is it just a tactical window to reposition? Because nobody knows. And that uncertainty is what's keeping volatility at these levels. Okay, so here's the question everyone in finance is asking right now. If this is a global shock, if oil is at $100 and the strait is closed, why is the US not falling off a cliff the way Europe is? The answer comes down to 3 things. And I'm going to break down each one. Shield number 1. The fiscal firewall. In July 2025, Congress passed something called the One Big Beautiful Bill Act. I know, great name. What it actually does is inject roughly $100 billion in retroactive tax refunds directly to consumers, plus significant corporate tax cuts. Treasury Secretary Scott Bessent literally called these bundles of joy. And analysts estimate this stimulus alone adds 0.5% to US GDP in Q1 of 2026. Think about that for a second. While the rest of the world is looking at energy-driven austerity, the US consumer has just received a massive cash injection from the government. That's a buffer that most other developed economies simply don't have right now. Shield number 2. The AI productivity dividend. Here's something that got almost zero mainstream coverage. In Q3 of 2025, US labor productivity surged by 4.9%. That's a remarkable number, especially because total hours worked barely moved. So businesses are getting significantly more output without significantly more input, and a lot of that is AI. Now, 2024 and 2025 were about building the AI infrastructure, spending on chips, data centers, the picks and shovels. 2026 is where that investment starts showing up in real-world productivity. And US firms are further ahead on this than anyone else. AI hardware, by the way, has returned 171% since early 2023. Software is at 72%. There's a gap there, and it's important, but we'll come back to that in the risk section. The point is, while the Eurozone is fighting an energy crisis, the US economy has this hidden productivity engine quietly running in the background, partially offsetting the damage. Shield number 3, the closed-loop economy. This one is underrated. If you measure how trade-intensive an economy is, exports plus imports as a percentage of GDP, the US is actually one of the lowest in the developed world. What that means in practice is when global trade routes get disrupted, when shipping lanes close, when tariffs spike, the US economy is structurally less exposed than, say, Germany or Japan or the UK. The American consumer is still the engine. And because the US is largely selling to itself, an energy shock that paralyzes international shipping lanes doesn't hit the domestic economy the same way it hits countries that depend on exports for their growth. So you've got fiscal stimulus coming in, an AI productivity bump running underneath, and a relatively closed economic loop insulating from the worst of the global disruption. That's the combination keeping the US different right now. But, and this is a big but, none of this is permanent. Now let's talk about what this actually looks like if you're not in America right now. Because for a lot of people watching this in the UK, in Europe, in India, this isn't an abstract financial conversation. This is your actual life. In the UK, there's a word that's become everywhere right now. Trumpflation. It's the idea that American foreign policy, specifically this war, is driving up costs for British households. And the numbers are genuinely shocking. The average 2-year fixed mortgage rate has jumped to 5.35%. Nearly 1,000 mortgage products were pulled from lenders in a matter of weeks. That's an extra £900 a year for the average mortgage holder. On top of that, petrol is at 144p a litre, projected to hit 150p by Easter. Diesel at 166p could hit 180p. And energy bills? Expected to rise by 20% in July when the price cap adjusts. That's an extra £300 a year on top of what people are already paying. For 1.5 million households that heat with oil and are not covered by the Ofgem cap costs have more than doubled. In Europe, the IEA is literally telling people to carpool and work from home. Slovenia has implemented fuel rationing. Consumer confidence in the Eurozone has dropped to its lowest level since 2023. Germany, the industrial engine of Europe, is stagnating under the weight of trade uncertainty and what analysts are calling the second China shock. And then there's India. On March 24th, literally yesterday as of this recording, the BSE Sensex jumped almost 1,400 points in a single session. Why? Because Trump announced the pause on strikes. That one political statement moved one of the world's biggest markets by nearly 2% in a day. That's how fragile the current equilibrium is. Infrastructure, stocks, aviation, consumer companies, they all surged. But energy companies like Coal India actually fell because the immediate fear of supply disruption faded. The market is incredibly sensitive to every single word coming out of Washington right now. Here's the big picture takeaway. The world is running a K-shaped recovery. And I don't just mean economically. Socially, psychologically, there's a growing gap between countries and regions that have fiscal space and those that don't. The US has fiscal space. Most of the world does not. Okay, I've made the case for why the US is holding up, but I'd be doing you a disservice if I didn't talk about what breaks that story. Because there are several things that could end American exceptionalism in the second half of 2026, and some of them have a meaningful probability of happening. Risk 1, the $140 oil scenario. Oxford Economics ran the numbers on this. If Brent crude averages $140 a barrel for a sustained period, not a spike, a sustained average, the US economy reaches what they call a temporary standstill. The UK, Eurozone, and Japan fall into definitive recession. Right now we're at $101. That gap between $101 and $140 is the entire buffer for global stability. And the only thing preventing us from hitting $140 is the current belief that the conflict de-escalates. If Iranian energy infrastructure gets hit, that belief evaporates fast. Risk 2. The Fed independence collapse.
I want you to understand how unusual what is happening with the Federal Reserve right now actually is. The Department of Justice is conducting a criminal investigation into Jerome Powell. His term ends in May 2026.
The administration has already nominated Kevin Warsh, who is expected to be significantly more dovish as his replacement. Powell himself said the subpoenas are a consequence of the Fed setting rates based on our best assessment of what will serve the public, rather than following the preferences of the president. Here's what that means for markets. If the perception takes hold that the Fed is no longer independent, that it will be pressured into cutting rates regardless of inflation, the dollar weakens, bond markets reprice, and the interest rate that has been a buffer against inflation suddenly becomes a political tool. This is the highest probability risk in the matrix right now, and it's barely being discussed. Risk 3. The AI debt trap. Remember I said AI hardware has returned 171%. Here's the flip side. Those returns were funded by an enormous wave of corporate capital expenditure. A lot of that capex is now starting to shift to debt financing borrowing to fund the next phase of AI build-out. If the productivity payoff phase doesn't materialize at the speed the market expects, you have a debt finance bubble meeting rising interest rates. That's a combination that historically ends in a sharp correction. The US is trading at 22 times forward earnings. International markets are at 15 times. There's very little margin for disappointment. So here's where we are. The US is genuinely holding up better than the rest of the world. The shields are real, but the risks are real too. And the question every single person watching this needs to be asking is, what do I actually do with this information? That's exactly what I want to get into right now. All right. Here are 3 things I think are worth thinking about given everything we've just covered. Number 1, energy exposure. If oil stays above $100, the companies benefiting are not the consumer brands, it's the producers and the defensive plays. The data set is clear. When oil spikes, infrastructure, aviation recovery plays once the conflict settles, and hard assets outperform. Gold has already moved from $2,600 to $4,370.
If you don't have any hard asset exposure in your portfolio right now, this is the environment where that conversation becomes very relevant.
Number 2, know which market you're in. The U.S. domestic market, consumer staples, AI infrastructure, companies that sell to Americans is operating in a fundamentally different environment than UK equities or European industrials right now.
Geographic diversification is great, in theory. In 2026, it's actively working against you if you're overweight in markets where Trumpflation and energy costs are compressing margins.
At least understand the exposure you have. Number 3.
Watch the Fed transition. When Kevin Warsh takes over from Powell in May, the rate environment could shift meaningfully and fast. Rate-sensitive assets, real estate, bonds, dividend stocks reprice when the rate policy pivots. That transition is coming in weeks, not months. Position accordingly. And look, I want to be clear. None of this is financial advice. I'm not your advisor. But this is the conversation that I think every investor should be having right now, and most people aren't having it because they're buried in the noise. If this video gave you a clearer picture of what's actually happening right now, not just the headlines, but the mechanisms underneath them, then do me a favor and hit subscribe. Because the situation in the Middle East is developing literally day by day, and I am going to be covering every major development as it relates to your money, not the politics, the markets, the portfolio implications. That's what this channel is about. I'm also going to link in the description to the full research brief I used to build this video. Read it yourself, form your own view. The worst thing you can do in a market like this is outsource your thinking entirely to someone else, including me. Next video is going to cover the Fed transition in detail, what Kevin Walsh actually believes, and what a more dovish Fed means for every major asset class. If you don't want to miss that, subscribe and hit the bell. I'll see you there.